not about the mechanics of an Excel spreadsheet. It's about the discussion that you're having with your leadership team when you're fleshing out your model and how it's going to survive in the marketplace. Hello, my name is Dave Conte, and I'm a serial CFO. I love high growth companies. Once you've been through that curve, you don't want to do anything else. I'm not a large co guy anymore. It's just so much fun to take an idea and bring it to market and to have it grow and build a company that has, you started from nothing, now you've got 100 employees. That was you. And you've got the courage that you're starting that now. My first venture in high tech was a little while ago. And I remember it was around about this time, Easter. We had a family get-together. My older brother said, "Hey, how's the new job?" I've been there 2-3 months. "Well, it's pretty good." "What is it that you do?" Well, I explained, "Well, it's this technology into this marketplace. Never been done before. It's going to be great." And he says, "Okay, I don't know what that really means." Because he's really a bricks and mortar type of guy. And I said, "Well, let me try to explain this." And I thought, how will he understand this? I can explain, I'm in the finance area. I take care of payroll and customer billing, shred. Shred's a cool thing. I could talk about that. But I said, no, I got to put it in terms that he'll understand. I said, well, I go to work Monday morning, I look at the cash balance, and I figure out if we run out of cash on Wednesday or Thursday of that same week. And then I do something about it. I solve it and I come back the next week. Of course, he looks at me, my young kids, my wife, and are you crazy? What are you doing here? You can get a job anywhere else. There's easier ways to make money, but it's never as fun as growing a high-tech company. Well, that Monday to Thursday company, we grew to 200 employees, 25 million, strategic sale, and all the way through it, we use financial modeling to help us through. And you're going to need that for your stages. Early stage, it's how do I get my first round of financing? And then telling the story about what it is, what we do, how we're going to get customers, etc. Your next phase, it's about, I made promises, I've got money. How do I deliver on that revenue? My God, it's not working out. How do I readjust the plan? And a financial model takes you all the way through to even when you're larger in 100+ operation, and it's an operational budget model. It's the same principle that you carry all the way through. Today we're going to talk about how you do that, the evolution of that, and the best practices I've come up with over the years. This year alone, I'm going to do 12 budgets for different companies. And each one is unique in its own way. In fact, each of you are unique, and your neighbor, the company next door, is special too. You've got a different market, a different price point, a different technology, value proposition completely different. Yet, each of you make payroll the exact same way. Use ADP, Ceridian, whatever. The payroll side of your world has been commoditized. That data set has already been identified. So there's components of your business that are very, very unique and special, and other components that are commoditized. And we're going to talk about the best learnings I've seen and where you should focus, because I think investors want you to focus in certain areas and not so much in others. So I'll give you a quick view of the slides we're going to go through. I need to walk you through the evolution of financial models. Then we're going to get into what I think it should look like. And then we're going to get into, if you do it really, really good, this is what it could look like. So let's get into each of these slides. When I run into CEOs, the first time they're doing a financial model, they're saying, you know what? It's Excel. How hard could it be? You know, my technology, that's hard. Breaking into a new market, that's really, really hard. And these are very, very bright individuals, as all of you are. You know, fundamentally, it's addition, subtraction, and sometimes on a good day, it's multiplication to create this budget model. I'm going to create one tab in Excel, and I'll just fill it with all this information. I'm going to describe my business in one tab. And then they start that process. All right, well, I'm going to have a number of deals. When are those deals coming in? Okay, great. The price. Okay, it's roughly going to be this price. We haven't sold it before, but I think this is a fair price. Oh, it might be tiered. Okay, I've got 3 different prices now. Oh, in volume, there might be a discount associated with that. I need people. I got to hire them. When am I going to hire them? There's some salaries. I got to build up my R&D. Sales guys have to travel. And, oh, geez, rent and you start filling in your one tab of Excel, and you get into, oh geez, revenue, they're going to want to know services versus license mix, CapEx versus OpEx, billings versus rev rec, cash flow, multi-currency. All of a sudden you realize it's just not going to work. This one page, the simple exercise of addition, subtraction, just fails. So you take a different approach. Stage 2. All right, I know what the answer is going to be. My revenue is going to start slow. I'm going to kind of go like this, and then it's going to take off in the market, and it's going to shoot up. It's the hockey stick. Now, I'm going to be conservative. It's not going to be exponential growth. It's just going to be a very steep slope, and it's going to be great. Well, guess what? That model is thinly supported, and investors see through it. They see hockey sticks all the time. My God, it's winter in Canada. There's hockey sticks everywhere. They discount that straight away. Now, many of us have our valuation as a function of revenue. So if they discount your revenue and your projection, guess what? Your valuation just took a hit. You just got diluted more. It's not a great place to be. So imagine if when you see that investor snicker at you when you show your hockey stick, you can have a response to that and say, hold on, I know you see hockey sticks all the time, but this is my hockey stick. And my hockey stick, when I double click on it, there's this whole revenue engine that supports it, that shows you that it's very well thought out. I can tell you that my first year revenue is coming from this group of customers. And some of them I actually have contracts with already. I can show you the contracts. They're multi-year contracts. And you've got to believe that my first year revenue supported by a contract that's signed is pretty solid. You've got to give me some credit for that. You want to debate about the termination language? It's solid too. I'll show you the paragraph. All right, if you accept that, then let's get into the new clients that are coming in. This batch of new deals over here, well, let me show you my sales funnel. And typically, in our business, we're seeing that it's a 5-month lead time to get that deal. You can see there's a corresponding group of customers and prospects up here that'll tie into that deal. Now, we believe it's going to be a 5-to-1 ratio that we need based on these external factors and the research that we've done. You can see that both on the number of deals and the total revenue associated, we've got a 5 to 6-to-1 ratio from here to there. That gives us confidence that these deals are going to come through. And so you have this conversation. And it's a two-way dialogue. It's no longer a one-way, you're presenting. They're trying to poke holes and justify and seeing if you know what you're talking about in this business model, because eventually what they're really doing is evaluating you. And so you have this discussion, and hopefully you do fairly well, and you come out to a draw where you say, all right, I'll accept that your assumptions are reasonable. Heck, they might even say, every once in a while I'll give you you're conservative. Great. If you accept that my detail is reasonable, then you have to accept the conclusion, which is my hockey stick. And so you defended your valuation. Now, they're still going to discount your valuation. They're still going to send you back to give you more realistic numbers, but they've already assessed you. You've stood up better than and others would in that same scenario. You can see that if you can have a financial model that has substance, drilled down behind the numbers, well thought out, then you're going to stand a better chance to get your funding. You get into the stage that I call the tool. It's much like a calculator because the structure of it has been QA'd. You've put it through, and it kind of works. You don't have to worry about the formulas anymore. It's just dynamic inputs and outputs. You can trust the outputs. So you put some inputs in, great outputs. All right. Now I'm working with my leadership team saying, oh, we've got this deal. It's in May. What happens if we move that deal from May to June? Let's flip over to the cash flow statement. We see, oh, cash got hit. That's not a good thing. I don't like that. You talk to your sales guy, and he's a little aggressive, saying, June, forget about June, May. I can do that in April. So you take the deal, you drop it in April, and boom, you can see the results in your cash. It's not about the mechanics of an Excel spreadsheet. It's about the discussion that you're having with your leadership team when you're fleshing out your model and how it's going to survive in the marketplace. Another example. We've got a model that is sound, it's balanced. We've got deals, we've got MRRs coming through. We're all happy with it. The whole leadership team's great with it. But what happens if I can get a segment of my population to pay me instead of, on a monthly basis, just quarterly up front? If I can put that in the model, I can kick out what the impact is on my cash flow statement. And that'll tell me maybe I don't need to raise as much because it's a good guy on my cash flow. Similar, my platform component in my solution, maybe I can convince my customers to give me the platform upfront on an annual basis. I've done that recently with one client. And the cash flow impact was fantastic because I'm going to take that cash, drive it back into the business, and drive more revenue coming through. Getting a tool that works, that you trust, and a discussion with your leadership team is the way to go because it builds the confidence for you to have that discussion with a VC because they're going to try to poke holes in it and see that if you've got something that's in balance and makes sense. It's great that you've got a tool now. And if we can get everyone to the point where we've got tools, fantastic. But I want to get you further. I want to get you to have the full confidence to tell your story. Because ultimately, your investors are going to be assessing you in the first 5 minutes, and they want to see your passion about the product that you're delivering in the market that you're delivering. So we've talked about this prompting and discussion, the balance. You've gone through and you've determined if I change this variable, what's the impact? Oh, not so much. So it's not a big lever, but this other variable here is a huge lever, so I need to make sure I nail that. But there's also this thing called this business plan. And often the business plan and the budget are created in isolation and should never be the case. The best ones I've seen, you start with your business plan, you build it up a little bit, you kind of, your market sizing, what you're trying to do, and then you go into your budget, you start fiddling with numbers and pricing, and you go back to your plan and back and forth, and all of a sudden you have this harmony between these two documents, and it all makes sense. This shows through in your investment all the time. So we want to get to the stage where you can tell your story, show your passion, sell yourself, and know that you're not going to get jammed on the numbers because the numbers are making sense with the story that you're telling. So let's show you how to do it. Again, best practices, take from this what you will, but it served me very, very well. And here's the abstract concept. We've talked about salaries. It's a data set that's been proven. Don't recreate it. Don't spend more time than you have to there. Lay out the components. I've got people. They have a name, a role, a department, a salary. I have timing when I hire them. I have timing when I let people go. I have benefits. I have salary increases. Done. Package it. If you want to spend more time there, I'd say stop. Go spend time where your value is, which is the revenue engine. That's all the blue spots. Now, this is unique to every one company, and you need to make it reflect what is so special about you. What is the customer value that you're driving? Your customers are running to buy your product because no one else has got this. You're organized, so you have a nice little revenue summary, and everything else feeds up into that. Now, the tabs that you create, the boxes, are unique to what you do. And that's where you sit and you try to figure out, all right, are we a price volume with assumptions play? Are we more product driven where we list out each of our customers in each of those? That's a dynamic discussion, and you flip back and forth, and oftentimes you have a hybrid solution. But ultimately, you figured out how you're going to go to market with this and how you're going to represent your numbers in a model and tie it together. It feeds up to the revenue summary, and that feeds out to your financial statements. Let's talk about those green boxes. We talked about salary. Data sets have already been defined. The green boxes, you don't get to define this. This has already been defined by the market. You need to come up with a balance sheet, a cash flow statement, and an income statement. In my world, I love having a two-dimensional income statement. It's the same data, just reflected two different ways. One is the traditional, here's my gross margin, it's by department. Gross margin, my sales and marketing expense, so I can do my customer acquisition cost metrics, that sort of thing. R&D expense, G&A. So I have a department, P&L. And then the other dimension is how I manage a company. It's where am I spending my money? What's my salary across all departments? What are my benefits? What are my people costs? Commissions associated with all that. Marketing. What's my nut on rent? How much of that is actually flexible and variable, and how much am I committed to for the next year and change? Your financial statements are something that you don't have a lot of choice. Just do it, create it, and make it look professional. Because when you're in front of the investors, what they're going to do is take those financial packages, feel very comfortable that they look very professional, gives you credibility, to take it, and then when you present, you're not talking about the numbers, you're talking about the charts. And I've given you some examples up here. Top right, Mr. and Mrs. Investor, let me show you our revenue is growing at this pace, our expenses start a little bit higher, but over time flatten out. kind of grows with revenue, but you could see that there's an intersection, and that's a point of profitability. But that's GAAP basis accrued accounting. Let's flip over to cash basis. This chart, the green bars are my cash balance. There's a blue line in there saying my net cash activity. And you can see that I've raised funds, and then I'm spending it because I'm building up my product set. But at some point, my revenue takes off, and so it goes. Cash comes in, and I'm cash flow positive. They want to drill down into your revenue engine? Great. I've substantiated. We're having this discussion. Here's a chart showing revenue by product. And in this example of a client of mine, you can see that there's a big blue bar in the middle, and they've got platform sales, mobile licensing sales, but majority of theirs is seat licensing sales. And they can see how that grows through the chart. It's a great story because not only is their business about acquiring new accounts and growing their customer base, but they can also have follow-on revenue growing within an account as the seats grow. And their value proposition is right to the user of the customer. So this user, this is a sales rep example, the sales rep uses their software, drives more sales for this telco client, and more value directly to the customer. Also, their revenue is tied to the customer's value proposition, and that's a great place to be. Ultimately, the investor goes, okay, great, tell me about your headcount. There's a chart over here saying early on we're R&D, and then at some point we have to grow our sales group, and then at some point we have customers, we need customer service people, and you've grown a chart like that. It looks very natural, and you see this and say, hey, this is in balance. Again, don't waste a lot of time on the green and yellow areas. Focus on the blue because that's your secret sauce, what makes you special. If you want to take it one step further, take it to the abstract. You've now got a budgeting tool that you can tune with your group, and you've got a scenario that you're all quite happy with. It's good. And I say, label it, save it, call it good. And I sit with them and I say, all right, what would great look like? It's now the future. I can see into the future. Things are going really well. What does great look like? What kind of revenue? What deals come in sooner? Is there more deals? And we start talking through what that future could look like. And it's quite an exciting conversation. You say, all right, we've got all this great revenue. What are the expenses associated with that? And so we build out our expenses. Because times are good, we're spending a little bit more. And we call this version great. We do the same thing. Hey, looked into the future, bad news, it's not going so well. These deals that you're thinking about, they're dragging 3 months. This other deal is not going to happen. And so revenue is a little bit lower. What are you going to do? And invariably, they trim their expenses, et cetera, to keep it in balance. Now we go to the investor and we can say, hey, top right chart, this is my revenue by product, and this is my good scenario. I've done sensitivity analysis, and I know that there's an upper limit of great and a lower limit of conservative. And yes, this is all guesswork, but this is reasonable guesses based on all these good assumptions that hang together, and it gives them a sense of tolerance of where this business might go. Certainly better than not having it. And then you look at the cash side of it. In this company, they're trying to figure out how long existing cash is going to last before they have to raise the next round. And you can see a tolerance, but the range on revenue is much wider than the range on the cash. Because when times are good, you spend a little bit more. Travel people more often, and you burn up that extra cash. When times are tough, you pull right back, and you conserve cash. So the range on cash is a little tighter. So for a company that's trying to figure out how much to raise, it's really great to have a little more certainty on what their cash probabilities would be. Again, this is all guesswork, but the exercise forces them to think through their business and come up with conclusions that they think are reasonable so they can go and raise capital that they need to drive their business.